What if your investments could literally pay you every single quarter just for holding them? No selling, no timing the market, no stress. That's the power of dividends. And here's what most people don't realize. Dividend investing is one of the oldest, most proven wealth-building strategies in the history of the stock market. Today, we're breaking it all down. What dividends are, how they work, how to evaluate them, and how everyday Americans are using them to build real passive income. Let's get into it. So let's start with the basics. A dividend is simply a portion of a company's profits that gets paid out directly to its shareholders. Think of it like this. When you own stock in a company, you're a part owner. And when that company makes money, some of those profits get shared with you. Most dividends are paid quarterly. That's 4 times a year. Though some companies pay monthly or annually. Companies like Johnson & Johnson, Coca-Cola, and Procter & Gamble have been paying dividends consistently for decades. This is real money deposited into your brokerage account, no selling required. Here's how the process actually works, step by step. First, a company's board of directors votes to declare a dividend. They decide how much to pay and when. Next, pay attention to the ex-dividend date. This is critical. You must own the stock before this date to receive the upcoming dividend. If you buy on or after the ex-dividend date, you miss that payment. Then there's the record date. The company confirms who the official shareholders are. And finally, on the payment date, the cash lands directly in your brokerage account. It's automatic. You don't have to do anything. That's the beauty of it. Now let's talk about dividend yield. This is the number you'll see most often when evaluating dividend stocks. Dividend yield is calculated by dividing the annual dividend payment by the current stock price. So if a stock pays $2 per year in dividends and trades at $40, the yield is 5%. Simple enough. But here's the thing. A high yield isn't always a good sign. Sometimes a yield looks high because the stock price has dropped sharply, which can signal company problems. Yields above 8% deserve extra scrutiny. Many financial analysts consider a healthy, sustainable yield to be somewhere in the 2% to 5% range, though this varies by sector and market conditions. Let's look at real data. Different sectors of the stock market tend to have very different dividend yields. Utilities and real estate investment trusts, or REITs, historically offer some of the highest yields because they're required by law to distribute most of their income to shareholders. Consumer staples companies like food and beverage are reliable mid-range payers. Meanwhile, technology companies tend to pay lower dividends, or none at all, because they prefer to reinvest profits back into growth. Understanding which sectors naturally pay higher dividends helps you build a smarter, more intentional dividend portfolio. This is the data telling us where the income tends to live. Here's a number that stops most people in their tracks. According to research from Hartford Funds, roughly 40% of the S&P 500's total returns since 1930 have come from dividends. Not just stock price appreciation, but dividends. That means nearly half of the wealth generated by America's most iconic companies over nearly a century came from those regular cash payments. And when you reinvest those dividends, buying more shares with every payment, the compounding effect becomes extraordinary. This is why serious long-term investors don't ignore dividends. The data is clear. Dividends aren't a bonus. They're a core component of long-term wealth building. Let me show you the numbers on what dividend reinvestment actually does to your portfolio over time. This chart compares 2 scenarios. $10,000 invested in the S&P 500 starting in 1994, with dividends reinvested versus without dividends reinvested, over a 30-year period. The difference is dramatic. The portfolio with reinvested dividends grows substantially larger because of compounding. That's when your dividends buy more shares, which generate more dividends, which buy even more shares. It's a snowball rolling downhill. This is the power of dividend reinvestment programs, often called DRIPs, and why many long-term investors set their accounts to automatically reinvest every dividend payment they receive. Now here's a metric that separates informed dividend investors from beginners: the payout ratio. The payout ratio tells you what percentage of a company's earnings are being paid out as dividends. Here's the formula. Divide total dividends paid by net income. So if a company earns $100 million and pays out $50 million in dividends, the payout ratio is 50%. Generally speaking, a payout ratio below 60% is considered healthy and sustainable. A ratio above 100% is a red flag. It means the company is paying out more than it's actually earning, which is not sustainable long-term. Always check the payout ratio before buying a dividend stock. It's one of the best signals for dividend safety. Let's talk about one of the most respected groups in dividend investing, the dividend aristocrats. These are S&P 500 companies that have increased their dividend payment every single year for at least 25 consecutive years. Think about what that means. Through recessions, market crashes, the 2008 financial crisis, COVID, these companies kept raising their dividends. That kind of consistency signals financial strength, disciplined management, and durable business models. As of 2024, there are approximately 65 companies that qualify. Familiar names like Coca-Cola, Colgate-Palmolive, and Johnson & Johnson are on this list. For investors seeking reliability and growing income over time, dividend aristocrats are worth understanding deeply. Let's look at how S&P 500 dividends have actually grown over time. This chart shows the historical dividend per share paid by the S&P 500 index going back to 2000. And despite two major market crashes, the dot-com bust and the 2008 financial crisis, the long-term trend in dividend payments has been upward. Notice 2009 had a dip as companies cut dividends during the recession. That's real and important to acknowledge. But the recovery and subsequent growth were significant. By 2024, S&P 500 dividends per share reached all-time highs. This long-term growth in dividend income is a key reason many retirement-focused investors prioritize dividend-paying stocks in their portfolios. All right, here's exactly what you can do right now to start building dividend income. First, if you don't already have one, open a brokerage account or, even better for tax purposes, a Roth IRA. Dividends inside a Roth IRA grow completely tax-free. Second, when evaluating stocks, always check two numbers: yield and payout ratio. Third, if picking individual stocks feels overwhelming, consider a dividend-focused ETF like VYM, SCHD, or DVY. These funds hold dozens of dividend-paying companies, instantly diversifying your exposure. And finally, enable DRIP. That stands for Dividend Reinvestment Program. Most brokerages offer this for free. It automatically uses your dividend payments to buy more shares, supercharging the compounding effect we talked about earlier. Here's something most beginner investors overlook: taxes on dividends. Not all dividends are taxed the same way. Qualified dividends, paid by most U.S. corporations and held for a minimum period, are taxed at the lower long-term capital gains rates, 0%, 15%, or 20% depending on your income. For most middle-income Americans, that's just 15%. Ordinary dividends, on the other hand, are taxed as regular income, which can be higher. This is exactly why holding dividend stocks inside a Roth IRA is such a powerful strategy. Your dividends grow and compound completely tax-free, and qualified withdrawals in retirement are also tax-free. At tax time, watch for Form 1099 Div from your brokerage. This is for educational purposes only. Always consult a tax professional for your specific situation. And here's the stat that really puts it all into perspective. According to research by Ned Davis, research covering 1973 to 2023, companies that consistently grew their dividends delivered a total return of approximately 1,764%, compared to just 430% for non-dividend-paying stocks over the same 50-year period. That's not a small gap. That's a massive generational difference in wealth creation. And it makes sense. Companies that can consistently grow their dividends tend to be financially strong, well-managed businesses with durable competitive advantages. The dividend growth itself is a signal of quality. Past performance doesn't guarantee future results, but this data makes a compelling case for dividend growth investing as a long-term strategy. Let's bring it all together. Dividends are one of the most powerful, time-tested tools in an investor's arsenal. They provide real cash income from your investments without selling a single share. When evaluating dividend stocks, always look at both the yield and the payout ratio. Yield tells you how much you're earning. Payout ratio tells you if it's sustainable. Reinvesting your dividends through DRIP programs is where the real magic happens. Compounding turns small payments into significant wealth over time. And if you hold dividend stocks inside a Roth IRA, you keep more of what you earn by avoiding taxes on that income. Start simple. Even a dividend ETF gets you in the game immediately. Build wealth with knowledge, not guesswork. Before you go, everything in this video is for educational and informational purposes only. It is not financial, tax, or investment advice. Always consult with a licensed financial advisor or tax professional before making investment decisions.